Let's name a name just for fun. We talked about Exxon before.
Hmm.
I think Exxon is selling at about 70 to 75% of its net present value at $60 oil. I think the oil price is going to 85 or 90. Uh, at 85 or 90, if Exxon is enjoying a 15% margin or 20% margin at $60 oil, they'll be enjoying 45% margins at
Mm.
$85, which is to say, I'm buying what I think is a company 5 years ago, 5 years from now, that will be worth 2 to 3 times what it's worth today. And I'm buying that at a 30% discount with a 2.5% yield. The fact that the quality of the company is so high and the probability of my being right is so high, that's what attracts me. For a 73-year-old patient rich guy, uh, juxtaposing the risk to reward, this is a sort of a one, one being best, 10 being worst,
Oh, okay, good. I was thinking the other way around. So okay, good. Thanks for okay.
because the probability of it taking place is so high. It is
Of future
estimated,
production,
yeah,
right?
it's
Yeah.
estimated that on a global basis, if you include state-owned firms, that the oil industry is underinvesting in sustaining capital by between $1 and $2 billion a day. Even the World Energy uh, International Energy Agency, no fan of fossil fuels, has revised their estimate as to when peak oil demand will occur from their recent estimate of 2030, only 4 years from now, to 2060. On a global basis, depending on who you listen to, we have invested, we being humankind, somewhere between $6 and $11 trillion on alternative energies. That's a T. It's a big number.
Big number.
And we've reduced the market share of fossil fuels from a high of 83% 40 years ago, all the way down to 81% today. A conservative estimate of a $6 trillion expenditure has reduced the market share of fossil fuels by 2% over 45 years. So I think that it's important that we get that in context. Important for a couple of reasons. When Wall Street, and in particular when the multilateral institutions do their net present value calculations on oil companies, they are using peak oil demand occurring in 2030 and then tapering off. If you do a net present value calculation on an oil company, free cash flow received after 7 or 8 years has almost no net present value. And you have to add back in your calculation the value of the tail, the value of the cash flow that occurs for 30 years in the case of Exxon after that 8 year time frame. And people doing net present value calculations today have left in no value for the tail. And the
Wow.
tail is enormous. Truly, truly, truly enormous.
Oil will hit $90. Exxon will be worth 2 to 3 times in 5 years. The industry is underinvesting $2 billion daily. The U.S. has drilled 85% of its best locations. Harold Hamm has 0 rigs running. Only 10% of companies are investing for the future. This is a when, not if scenario. The math is inevitable. The cure for low prices is low prices. Prepare now.
At the same time, uh, this vilification of the oil industry has made the oil industry's cost of capital go up.
Hmm.
The oil companies are selling for less than they're worth, and very big lenders are exiting the oil and gas space. A combination of low oil prices and relatively expensive capital has meant that many oil companies are deferring sustaining capital investments in favor of returning cash to shareholders. Shareholders like cash, but they ignore the fact that that cash return now is coming from what could be called cannibalization. The situation's nuanced too. I hope your listeners will pay attention to this next part. At $60 oil, with current interest rates, it is estimated that the U.S. industry has drilled 85% of its tier one locations. which means that with today's technology and today's cost of capital and today's fiscal regime in the United States, 85% of the locations that have driven Americans' production gains have already been drilled. Now, certainly, if technology improves, particularly around recoveries, well recoveries, more locations that are currently tier 2 locations become tier 1 locations. But given the status quo, given $60 oil, which is higher than the quote today, with today's interest rate and today's cost of capital, we have drilled 85% of our tier 1 locations. The longer that oil stays below 60 or 65, the lower our ability to maintain the U.S. production at its current level becomes. And make no mistake, over the last 15 years, the U.S. has been the world's swing producer. We've gone from being the largest oil importer in the world to being an oil exporter as a consequence of the shale drilling. But the shale drilling at $60 oil is past its prime. It's important that people understand that. Will this...
And Rick, sorry to interject, but how important a signal is it to you of what you just said that Harold Hamm has no active rigs right now? And just for folks know, he's been basically drilling in Permian, I think it is.
He's mostly up in the Williston Basin in North Dakota.
But basically, he's been one of the most active drillers for the past several decades. And he's basically saying, right now, the economics are so unfavorable. For the first time in my career, I'm sitting on my hands.
That's correct. He's traditionally run 15, 20 rigs simultaneously. Right now, he's running none. What he's saying is that at $55, he doesn't earn his cost of capital drilling locations. He's decapitalizing. Make no mistake, he's raising cash, biding his time. He knows for sure that the cure for low prices is low prices. And he understands better than anybody how the conjunction of technologies has enabled the current boom and how you need either lower cost of capital or higher prices or a new technology cocktail. But if you take Mr. Hamm and you extrapolate his actions across many, many, many smaller private parties and across many large independents and majors, what you'll see is that what he's doing is indicative. It's not limited to him. The U.S. rig count, the number of active rigs in the lower 48, has fallen like a boulder off a bridge. As I say, this doesn't necessarily impair our production in 2026 or 2027. But if you don't drill for 2 years, which is what we're doing in the United States, the impact in the out years is dramatic, and you can't bring that production online quickly. In other words, you can't decide to start drilling and have production materially increase in 3 months or 4 months or 6 months. You will remember, Adam, after the precipitous price decline that we experienced during COVID, when the oil price went briefly to zero and set out at $20, we had a complete hiatus in drilling in the United States. And the consequence of that, the aftermath of that, was $90 oil. That's the way it works. Yes, but you need to confine your purchases today to companies that are making the required sustaining capital investments, to companies that aren't cannibalizing their ability to take advantage of higher prices.
Great point.
Paradoxically, the market is favoring companies who are cannibalizing themselves and paying high dividends and buying back stock. So Wall Street is buying precisely the kind of companies that will underperform in the scenario that I've envisioned. You need to confine your purchases to efficient companies that are making the required sustaining capital investments so that when the oil price rises, they will have the production to fully take advantage of that circumstance. And I would suggest, I haven't done the work statistically, but I would suggest that probably only 10 to 15% of the oil companies on the investable horizon are maintaining sustaining capital investments. Some of these companies, Adam, are making so much money based on historical capital investments
Hmm.
that they can at once be generous with their shareholders on a current basis and still make the sustaining capital investments. That's really sort of the trifecta. This family has been active in West Texas for 100 years, and they are at once living very well. No questions as to what they might have to have for breakfast,
Hmm.
while at the same time, uh,
Investing for the
it,
future.
investing for the future. And that goes all the way up to Exxon, which is treating its shareholders at present very well, maintains a fortress-like balance sheet, and never mind is making the required sustaining capital investments. They're investing billions of dollars in new projects in Guyana while buying Pioneer.
This really smells like opportunity. It seems like a classic, Rick rule. Um, be early, start building your position when valuations are lower than you think they're going to be in the future once the phase change you think is going to occur. But it almost sounds like it's even better than the normal Rick rule. Like I remember you out there talking about uranium, right?
Right.
And you were early on that, but man, were you right when the ship arrived. But you didn't get paid to sit in uranium, right? Where here, some of these companies, as you said, are still paying you really attractive dividends while you're dollar cost averaging in and waiting for the phase change.
That's a great point, Adam. Not this uranium market, but the one before it, 1998. I was 4.5 years early. If you're 4.5 years early at an 8% discount rate, you're not early, you're wrong.
Hmm.
So you have to consider the time value of money. Uh, if you get paid a nice dividend, you discount most of the time value of money. If you put together, as an example, a package of the better Canadian producers, you're admittedly taking, by the way, Canadian political risk, which is high. But you have an average dividend yield of around 6%. If you're using an 8% of cost of capital, that 6% dividend amortizes away most of the discount,
Hmm.
which is a much more attractive circumstance than the circumstance that I faced either in my uranium trade or in my silver trade, where I ate the whole time value of money discount,
Right.
in both cases being 2 to 4 years early. Uh, the other thing is, Adam, that I think is worth noting, the oil and gas business is a better business than the mining business. I was brought up in the oil and gas business, so I have an affinity to it. But in the oil and gas business, we always talked about return on capital employed. There were years in the mining business when we prayed for return of capital employed. It is a bigger business, it is a better business, and it has, on average, higher quality people. The fact that you can engage in a thesis that is similar to the contrarian thesis that worked out so well for me in the mining business in a better business with higher quality people is a hell of a bonus. The opponents to my point of view say, Rick, you are ignoring a bunch of things. You are ignoring the fact that Venezuela, Trump just changed the world in Venezuela.
Hmm.
Well, first of all, he didn't. He just kidnapped their thug. There's a bunch of sub thugs that are still in power. Nothing changed except for that the thug in chief and his wife is now in custody. Yes, we stole some of their oil on the high seas. We may continue to do that. But in order for Venezuela to recoup their former production levels, one would estimate it would take 50 or 60 billion dollars and several years. And as the CEO of Exxon said last week, he knows a bit more about oil than our president, by the way. Um, Venezuela, in its current circumstances, is uninvestable. So it'll be tough to raise that 50 or 60 billion dollars. Maybe Trump will take it out of our federal surplus. Who knows? And then people say, well, what about Russia? Or what about Iran? Those are two countries that have had desperate cash needs for 5 years, which means that they are among the worst culprits in deferring sustaining capital
Hmm.
investments. To the extent that the politics of either country stabilized, and I'm not a geopolitical analyst, so I'm not going to tell you what the probability of that is. It would take years to restore their domestic production capabilities, given the cannibalization that has occurred in both countries, in Persia for politically expedient domestic social spending programs, in Russia for war. The variable in the world has been U.S. shale production.